Thank you for joining us for the Biotech Plus Fund Launch Call. My name is Rob Anton, Managing Director with NextEdge Capital. And prior to passing on to Eden Rahim, the manager of the fund, I wanted to briefly provide a quick framework and context for the call. I will then give the call over to Eden Rahim, where he's going to be giving an overview of the biotech opportunity, a state of the U.S. and Canadian biotech markets, explain the fund's investment process, in addition to the hedging overlays that will be deployed and why. There will also be an opportunity to answer questions at the end of the presentations. There are two ways that you can ask questions. In the control panel, you can either raise your hand or you can type the question out. Only we can see the typed questions. Please wait till after the call to raise your hand, whereby we will address you and turn your radio or audio on. Eden and his partner, Mike Bird, joined NextEdge Capital in the summer of 2014, and this fund is one of two mandates that we have recently launched with them. NextEdge Capital, for those unfamiliar, was formed in July of 2006 and renamed NextEdge Capital after the spin-out of Man Investments Canada Corp. From Man Group PLC in June of 2014. NextEdge Capital is licensed as an exempt market dealer, portfolio manager, and investment fund manager, and is focused on providing unique, non-correlated investment ideas to the investment community. The Biotech Plus Fund is designed to invest in North American small and mid-cap companies of the future within a well-defined process that I'll let Eden discuss. The fund will give Canadians access to an area of investment that is, at least to our knowledge, not available in an investor-friendly format. As an incentive for the first initial $10 million investment in the fund will offer special classes whereby no management fee will be charged for life of the time that those investors hold those units. Once the initial $10 million of assets is reached, those classes will be turned off to new orders, and the regular classes of the fund will be available with a management fee of 1.25%. Eden Rahim's experience includes 2 decades as a portfolio manager on a number of different mandates. Some background prior to him joining NextEdge Capital this past summer include a top quartile 5-year, 5-star Canadian growth fund track record as a portfolio manager on over $1 billion of assets while at Royal Bank Investment Management. More recently, while at Horizon ETF, Eden managed an option book spanning over 250 securities globally and 4 commodities, in addition to 14 covered call ETFs, managing over $500 million of assets in Canada, US, and Australia, employing his dynamic options writing discipline. And finally, and of relevance to this fund, Eden's been able to deliver a 26% compounded annual return over an 8-year period across an institutional biotech mandate between 1995 and 2003. That compares to a 14% return for the benchmark over that same time period. As well, over that period, Eden was able to outperform his peer benchmark in 6 of those 8 years. With this, I will pass it over to Eden.
Thank you, Rob, and thank you all for joining us on this brief call. On it, we will discuss why biotech, healthcare versus other sectors, when in the development stage of companies that we actually choose to position, what is our approach to investing in this space, and where among the 130 or so listed Canadian healthcare companies and over 500 US healthcare companies we are likely to focus our discipline on. And finally, how we've made it possible for investors to gain exposure to this exciting, innovative, smaller mid-cap companies emerging in the space in Canada and the US. What is unique about this particular period is that biotech benefits from low interest rates, slow growth environment, which we've been in the past few years and highly likely to be in over the next few years. It is also a risk-on way of diversifying away from resources and financials where investors have crowded in during this past cycle. I will review a bit of my investment process and the overview of the biotech industry before we get deeper into what the decision-making process is like. The biotech opportunity is vast. We've entered a new cycle after 10 years in the wilderness, and this cycle is very different to the other prior to biotech cycles in the 80s and 90s. As a case in point, most of us can recall roughly 15 years ago when the human genome was decoded. That was a groundbreaking event, and it made much headlines. But it cost about $3 billion to decode that human genome. Well, about 10 years later, a company, Illumina, unveiled its HiSeq X10 device, which could repeat the same task at $1,000 per genome. And what that underscored is that during this cycle, the speed of fusing technology with biotechnology has been very significant in advancing what the accuracy and the speed of development that drugs can be developed. And a lot of that is underscoring and fueling the rapid advancement that we've seen over the past 5 years. The other attribute about this cycle is that the regulatory environment has become much more flexible and adaptive. In particular, the FDA has initiated certain reforms, such as PDUFA 5, where it has lowered the bar by which orphan drugs and rare disease drugs can actually get to market. And we've seen a number of successful companies IPO in the past couple of years that address small unmet medical needs, but for which there's a high mortality rate. One of the exciting things about this cycle is that while we've seen resources struggle over the past few years, we've seen biotech and healthcare really deliver exciting companies that have turned out to be tomorrow's winners. So this cycle, we've seen a large number of companies emerge from the small mid-cap space and advance into the large cap space on the back of blockbuster drugs and innovative technology. One of the enduring attributes of investing in this space is that it is providing life-saving drugs that address unmet medical needs, and given the demographics that's unfolding, an aging demographic, it is able to address chronic needs that to this point have not been able to be treated. An example of the kind of progress that we've made is that biotech has been a significant contributor to improving mortality rates in cancer, heart disease, and HIV. In contrast, over the next decade, as we've seen the mortality associated with diseases like Alzheimer's, over the next decade, biotech is also likely to begin contributing to improved outcomes in CNS diseases such as Alzheimer's and Parkinson's. While substantial progress has been made in most cancers, a large unmet medical need remains in stomach, brain, esophageal, lung, pancreatic cancers. But we are seeing several drugs in trials right now that can address these needs. And again, one of the true attributes of biotech is that because of its recombinant technologies and the novel mechanisms of actions that are being discovered, they're able to address needs that were previously unaddressable. Biotech is unlike many other sectors that we are accustomed to investing in. One of the key attributes is that there are high barriers to entry. So it's not homogeneous. So for instance, with banks or with resource companies, there is a fair amount of how homogeneous one company is with the other. They look alike, the same tools of analysis can apply. But with biotech, it's very different. Once you've developed a novel mechanism of action, you can have that patented. You'll get 17 years of protection with that. You can formulate, your formulations can be patented. There's a certain amount of complexity and cost that's associated with developing a drug that contributes to the barriers to entry, and in addition to the novelty and the manufacturing of those drugs. So there are different areas in the food chain that companies can develop expertise in, whether it's in drug development, whether it's in the manufacturing of these recombinant drugs, formulation of these drugs. For instance, one of the very successful healthcare companies that we've had over the past 2 or 3 years in Canada has been Cipher Pharmaceutical, and that is based on reformulating an isotretinoin drug for acute acne, and they found a better way to deliver it with a safer profile, and it has become highly successful. And again, that's just one attribute of one company finding a better way to formulate another drug. So there are many ways to participate in the growth in healthcare. One of the other qualities of biotech is there is a high merger and acquisition rate, especially among the sort of companies we like to invest in. Larger companies, it used to be typically larger pharma that would go in and acquire companies in phase 2 and phase 3, but we're seeing large biotech actually do the same now with increasing aggression to build their pipelines and their technology platforms up in phase 3. As an example, you might recall that this year, Intermune, which in the spring was roughly $10 a share, reported favorable phase 3 data for its idiopathic pulmonary fibrosis drug. The stock soared to $30 to $40 a share, and then shortly after, Roche bought it out for $70 a share. So that was 10 to 70 in a span of a few months based on the success of a phase 3 drug. What's remarkable about that is that Intermune's ITP drug is not expected to be profitable for many years, and Roche bought it on the expectation that it's going to be a $700 million to $1 billion drug, 5 years into the future. So that's the kind of M&A that big pharma is looking for, and what they're willing to pay for some of these drug candidates, and again, in the area that we like to play in. Typically, most of these companies will sell somewhere between 4 times and 10 times enterprise value to EBITDA. However, the more novel the drug compound is, the more likely pharma and biotech is likely to pay for these companies. One of the exciting aspects of biotech is the large number of potential breakthroughs that will emerge over the next decade. We've already seen over the past decade or two the breakthroughs that have occurred that were previously unimaginable. But now there is a new frontier, and the tools by which companies can develop treatments for these unmet medical needs are rapidly evolving. So, for instance, one of the areas that we think that biotech will address and healthcare will address over the next decade includes neurological indications such as Alzheimer's and Parkinson's, continued success in autoimmune diseases, where biotech has been most successful over the past 15, 20 years. We've seen gene therapy and stem cell therapy emerge with recent successes such as Blue Bio. And we think that there are also other areas that will emerge, such as agricultural biotech over the next decade, the tools such as bioinformatics that makes it possible to improve our knowledge as to how protein folding will lead to different drugs. That is one area of innovation that we look forward to participating in. The fund will invest in both Canadian and U.S. biotech. They have actually departed in different ways. And so U.S. biotech had spent, like Canada, a decade in the wilderness and then broke out roughly in 2011. They have evolved into a 3-year bull market, mostly driven by profits and sales growth. Canada has been in a bull market, but it's really been the specialty pharma sector, not the recombinant drug sector of the market. So we think that there is an opportunity in Canada to participate in emerging companies that have yet to join the bull market that's occurred in the U.S. There are specialty companies that have they always say that necessity is the mother of invention, and specialty pharma has emerged. They've created a new model to to market, develop drugs, and dispense it, and turn into growth companies that way. And that's the market evolving. But we think there are opportunities in other areas as well, and we hope to participate in that growth. That being said, there is still a huge stable of phase 2 and phase 3 companies in the U.S. that we think will hold a high possibility of growing into big growth companies in the future that we hope to invest in and participate in for the long term. Looking at the chart, you can see that biotech spent about a decade basing after the crash from 2000 to 2002. They spent about a decade in the wilderness. There was heavy amounts of spending on research and development during that period of time. But what was curious is during the crisis of 2008, when the S&P fell sharply, biotech actually began to act very strong and held up very well. That perhaps was a harbinger of the bull market that would follow. And since then, biotech, after 2011, took leadership in the market and has held on to that leadership. So even today, with NASDAQ down almost 2%, biotech was almost untouched as money that flowed out of technology looked for safety in biotech. One of the issues that have surfaced over the past few months is that concern that large cap U.S. biotech is overvalued and it's in the bubble and so on. But in reality, if you look at the numbers, big pharma actually sells about the same forward multiple as big biotech, except big biotech is growing earnings and revenues at twice the rate as big pharma. So if you were actually to look at the numbers, perhaps big pharma is more overvalued than biotech, because biotech, for the forward multiple, you're getting great visibility, higher R&D as a percent of sales spending on future drugs, faster sales growth, faster earnings growth. This chart shows actually it was compiled by a crack technical analyst, Mark Derriette at Cormark, who created this index by equally weighting Canadian healthcare companies with a market cap of 25 million or more. And what it does, it shows that if you X out the effect of companies, large healthcare companies in Canada, such as Valiant, Catamaran, and so on, you can see that the smaller companies really haven't done that much. There have been, sporadically some companies that have had great success, again, like Cipher, and so on. But most companies, most small Canadian healthcare companies have sidestepped the bull market to this point, even though they've been basing for several years, perhaps as a harbinger of emerging into new bull markets. Again, we know these companies well. We think we know which ones give us a better chance of participating in the bull market that would follow these companies. And that's where our focus will be in trying to get investors exposed to a broad range of these potential winners for tomorrow. Now we'll take a look at the investment process in positioning in healthcare companies. In particular, for biotechnology, we know that it's a long, expensive road to bringing, identifying a drug, developing the drug, taking it through clinical trials, and getting to commercialization. It's about a 10 to 12-year process, costs hundreds of millions of dollars, and at the end of the day, you can have a failure on your hand. If you are successful, obviously, then, the sky's the limit as to how far these companies can go. That being said, in the decade or so long process that it takes to develop a drug, we tend to focus on a 2 to 3 year window in the late stage of that drug development. So we almost exclusively never participate in preclinical or phase 1 companies. We do in a few phase 2 companies, but primarily we're in post-phase 2, holding through phase 3 and getting out before either pivotal data comes out at the end of phase 3 or FDA approval. So typically the process will involve investigating and following companies while they conduct a large placebo-controlled double-blind trials in phase 2, waiting for the data to emerge. If the data is favorable, we know we have a good drug. We can assess it better. We look at peer-reviewed papers and so on, and then we make the decision whether to position. And we'll hold it through phase 3. And before pivotal data emerges, we will, do one of 3 things. We will either substitute the stock out, we will hedge the position, or we will substitute into call options. But our key focus is on de-risking the position all the way through. Some of the unique aspects of our investment approach is that, there are many ETFs and funds out there that will give you exposure to the largest biotech and healthcare companies out there. We're focused on the smaller to mid-cap companies, particularly the mid-cap companies. We think that's where tomorrow's winners will emerge. We take a basket approach. We know that individual companies can be greeted with failure after a long development process. We understand that. We will have our share of companies that fail clinical trials and we suffer as a result of it. But by taking a basket approach, you can mitigate the effect of this, and you can allow your winners to more than make up for that. We have an action plan devised for every company in our portfolio as it faces binary events, what we will do in the face of that binary event. And a cornerstone of our approach is using different hedging strategies to protect against the risk of those binary events and of macro risks affecting the portfolio itself and the sector itself. So as I mentioned earlier, our portfolio will be comprised of roughly 40-60 to 50-50 US and Canadian healthcare biotech companies. Our universe of possible investments will span a range of subsectors within the healthcare, and we will abide by a risk-managed discipline that we've refined for over 20 years, which I'll go into a bit more detail. And again, as I mentioned earlier, we protect against binary events. We use different strategies to reduce the volatility of the portfolio, and occasionally when the opportunity arises, generate some income, which will supplement returns for investors. We expect to hold somewhere between 40 and 80 holdings in the portfolio, and that changes based on where the market is in the cycle. So if the market's at the top end of the cycle, we will tend to hold fewer positions, concentrate in our core holdings. If the biotech sector has had a big correction, and such as we had, let's say, between February and May of last year, where the index fell about 25%, then we'll obviously, at that point, at the terminal stage of that, we will increase our holdings to get bigger exposure to the sector. We expect our top 10 holdings to have weights of somewhere between 2 and 5%. As mentioned, we tend to hold at the end of phase 2, anticipating the outcome of phase 3, but we're almost never around for FDA approval. We're really data-driven, and we're usually out of the position. We don't wait around for FDA approval. The market is fairly efficient once data comes out in pricing the potential possibilities for these companies. The FDA approval is usually anticlimactic, and actually, typically, post-FDA approval, many of these companies, no matter how big the drug is, will sell off substantially, 25 to 50%, and that will give you a re-entry point. So even take something like Gilead with the blockbuster Sovaldi, that is perhaps the greatest drug launch ever in the history of healthcare. Even Gilead sold off 25% post its approval. So if it's going to happen to that, it's going to happen to most every other company. So hence, we don't stick around for approval. So why do we even factor in hedges as core to our strategy? Well, again, as we mentioned, binary events are an attribute of biotech companies. They face different hurdles along the way: phase 2 data, phase 3 data, NDAs, interim looks through data safety monitoring boards, PDUFA dates, approvals, cash raises, conferences where they present data. All these things represent hurdles and events that could revalue the company. It's just germane to the sector, and it's something you have to live with. And you have to find a strategy to manage this. As we all know, we've all heard stories of outsized changes into the underlying biotech stock. It reports great data, the stock soars. If it reports negative data, it falls 50 or 60%. The other attribute of biotech is that it has periodic corrections, and it's healthy. It's good to have these corrections along the way. It takes some of the froth occasionally, and froth such as we've seen with CAR-T companies recently, such as Juno and Kite and others. They've had huge moves, and it's pretty frothy. It's good for the market to let out the steam from companies like that. Last year, as I mentioned, we saw a 25% correction, and yet the bull market continued. Biotech corrected 25%, resumed, and the bull market went to new highs. Since 2009, we've had corrections of 13%, 15%, 22%, 13%, and 25%, and yet a bull market rages on, and that's a good sign. The other attribute about biotech is its implied volatility is substantially above the S&P. So, we're used to market volatility. Volatility with biotech is high. So, option strategies and hedging overlays allows us to mitigate the risk associated with this volatility and also to harvest some of this volatility and turn it into returns. To summarize what we've covered so far, we are in the midst of an innovation boom. We've been in innovation booms like this before, when Genentech IPO'd in 1980, when Amgen developed EPO and UPO back in the late 1980s. There was a boom into the early 90s, and we all know the boom that occurred between 1998 and 2000. But this boom is very different. We've heard a lot of people come out and say, "Oh, it's a bubble," and I think they say that of virtually every bull market that emerges out of a 10-year base. Initially, it runs away and they say it's a bubble. But, what's unique about this is that most people have been outside looking in. They haven't participated in it. With a bubble, there are a lot of people participating in it, and it becomes the de rigueur conversation among many people. That has not been the case. It is simply a new bull market. It is under-owned and undercovered, especially in Canada, and especially after a decade-long bear market. So we think that opportunity abounds in the space. Some of the virtues, again, of the space is that there are high barriers to entry. It is not something where any other company can simply obsolete you away. There are high barriers to entry, and as a result of that, because of the high property values for novel and innovative drugs, there's a high degree of M&A. Big Pharma has spent less on R&D as a % of sales and dedicated more of its resources to acquiring companies. So I'll pass it over to Rob now for the conclusion.
Yeah, thanks, Eden. Good overview of your fund. And, what I'll mention as well is that, Eden is very open to going in more detail for those of you that are interested in this product. We're obviously very excited to have launched this fund. We've opened it up for orders just over a week ago. Order flow is coming in nicely. We're expecting the fund to go live with its first investment sometime in the next week or two. So, and mention that first $10 million will receive that special zero management fee class. We're excited about the fund. The fund, is an opportunity to give investors, an opportunity to invest in an exciting space, a sector that I think is on a fund basis not really represented in the small mid-cap area within Canada. You get exposure to an experienced manager, one that's very passionate in the space, with a well-defined process that's been used in the past, in a very easily accessible mutual fund format that's available to all investors. Eden's someone that's very passionate, in the biotech business, experienced, well-respected, and very connected. In fact, it's that network that's, immersed in this biotech space that prompted him and us to come out with this fund. What I'll now do is open up the call to any questions. As I mentioned before, there's two ways you can ask questions. In the control panel on your screen, you can either raise your hand or you can type a question out. Only we can see the type questions. If you raise your hand, we will address you and turn on your audio. First question is what percentage of the holdings will be Canadian versus U.S. holdings?
We expect it to be roughly 40% Canadian and 60% U.S. And that is, that ratio is really defined by the opportunities that are available and the market capitalization. So the U.S. clearly has a substantial number, larger number of companies that meet our criteria than is available in Canada. Some of the companies that we do like, they've already had large moves, so we likely won't be owning those initially.
The second question here is what fees will we be subject to if there are performance fees? How will they be determined? As with even with the zero management fee classes on the initial launch of this fund, there are some expenses to the fund, such as legals and audits that will be charged to the fund, as well on all classes, whether they be the initial founders class or the regular classes afterwards. There is a performance fee charged of 20% of all profits above a hurdle index, which is a combination of 60% the NASDAQ Biotech Index and 40% the TSX Healthcare Index. So any profits above that are charged 20% of all profits. Next question. Typically, how many holdings do you anticipate in the fund, and any idea on the potential turnover rate? And maybe add to that, Aidan, how you would change from a broader number of holdings to a less broader number of holdings as well with that question.
Okay. We typically expect to hold somewhere in a range of 50, possibly 60 securities. The top 10 holdings will have weights of roughly between 2 and 5%, and the other holdings will have weights of the range of 1% or so. As they advance and as they achieve some of the hurdles and successes we're looking for, then those weights will go up accordingly. As for the turnover rate, most of our core positions are long-term positions, but because biotech is volatile, there will be periods where the turnover is higher. So what we might do is, if some of our core positions have had big moves or some of our smaller positions have had big moves, we'll trim this, and we've done this in the past. It's how we managed. We've trimmed it. We don't want to give back outsized gains on our holdings. We want to lock it in. And, if it's not hedgeable, we will just reduce the position and then increase it again after periodic corrections.
Okay. Another couple of questions somewhat tied into each other, but there's two parts to it. I guess your definition of small cap, Aidan, are you using the generalized U.S. definition of small cap, sub 2 billion, or Canadian definition, or a combination of both? I guess is one question.
Yeah, it's a combination of both. So in the U.S., small mid cap, I would define as under 2 billion in market cap, and in Canada, I would count that because of the complete bifurcation in valuations in Canada. You've got a few companies that are north of $1 billion that generally aren't biotech companies, and then you've got a large population of companies in the sub 500 million. And it's really in that sub 500 million capitalization space in Canada that we will be positioned.
I guess within that as well, in some of those companies, would your typical company have, 1, 2, 3 or more products, or how many products are in the development cycle, or what is there a typical company?
Yeah, typically with healthcare companies, they have a technology and they'll have multiple indications in development for that mechanism of action. But they will have one product that's in lead, and that's really what we're focused on. It's generally after they've commercialized that you will see a second product, advance in development. But generally, most of these companies are one-product companies in development, and that's, it's unfortunately it's the nature of the beast. You have to get to larger cap biotech companies to get multiple products. So, even in Canada, the successful companies, they may have, multiple products, but there is one lead product that's driving valuation, and the others are more ancillary products with little or no revenue.
Great. Thank you very much, Eden. And there's no more questions on the call, so we'll just wrap things up. Once again, thank you very much for joining us today. A copy of the presentation and marketing materials will be sent out to everyone following this presentation. As I mentioned before, we're very open to discussing, this strategy with you further. Give us a shout or send us an email with any questions, or if you'd like to set up a meeting. And enjoy the rest of your day. Thank you very much.
Thank you very much.